So today's Cardinal lesson, long-term care insurance, where we're making a comparison of 5 different policies with prices, the amounts you have to pay, rates, and with similar benefits so that you can compare and contrast several different policies. And there's a danger here doing this is we get into the numbers and we stay in the numbers. We could spend a month just going through all these numbers and the different variations. And it's my experience that these numbers are not going to cause people or move you, not people, but you, to actually do something about the problem of long-term care. This is a future problem for those of you that are watching this video, for most of you. It's something that's going to happen way in the future. And unless it could happen to you soon, but it's something, if it happens to you, that's going to be way in the future. And what we want to do is we want to impress on you the need to prepare for that. I mean, and so the danger here is we just go right to the numbers. We show you all the policies, the different ways to take care of this. You can evaluate it, decide whether you want it or not. And you're probably going to end up, no, I don't think I'm ever going to need that. Or, I don't want to buy that because I heard they raise the rates on you later and I may have to drop it. Or, if I don't ever use it, which I don't think I will, then all that money's gone down the drain and it's gone. I mean, I could give you a million reasons not to do this. And if you do a study of the numbers and an analysis of the numbers, you're probably going to end up there. So I wanted to give you 5 different ways to solve this problem or to attempt to solve the problem. And we got that today. And this is everything that's on the board is backed up with an illustration that's in the show notes. So I'm going to turn it over to Tom, and Tom's going to go over the why of why we're doing what we're doing today.
Yeah, I mean, I think of all the things that we talk about on this channel, long-term care is the biggest risk that you face in retirement. This can be the thing that upends all of your plans. And if it happens and there is no plan in place, it causes a crisis. It's a crisis for you. It's a crisis for your spouse if you're married and your kids. I mean, really, who bears the burden of this is your family. It's not you needing the care. It's your family who's having to provide that care or step in and try to figure out how to provide that care. And I think it's telling that when we meet someone who is excited and interested in wanting to do this planning, more than likely it's because they've experienced this with their parents. They've seen their parents go through this. They know what it looks like, and they don't want to put their kids through the same thing. And so I think just take that and really ponder that and think on that of like, okay, if someone who's been through this with family doesn't want to put their family through that, I think it's worth thinking about how to plan here. And so let me bring up the show notes. We have the board. You can find these on the link below our video. They're also on our website. We're not going to look through all the show notes today because we have all these illustrations that we have on the board there. As we're going through the video, we will just point out which illustration, like what company it's with when we're going through, so you can go find it on your own. But it's like, and I think the show notes today, it's like 130 something pages long. So, I mean, you'll just notice there's just a bunch of illustrations here. So as we're going through the board, we'll say, okay, this one is nationwide. This one's One America. I mean, we'll point it out because you can see that it's just quite lengthy. And so, we'll go through there. We'll point it to you. If you want to print them out or go online and go find the one we're talking about, if it intrigues you, that's how you can sort of match up the board to all the illustrations we have in the show notes.
As I said earlier, this is a future problem. And our business, our practice is helping people most of the time in their 60s. People are getting ready to retire, they're retired, they're going on Social Security, or they're delaying Social Security, they got to get on Medicare once they're retired. And so we use that opportunity to talk to them about all the things in financial planning. And most of the time, we're taking Medicare and Social Security and long-term care and wrapping it all in a financial plan. But when I said earlier, this is a future problem. So if you're in your 60s or your 50s and you're preparing for this in advance, good news about being in your 50s, it's going to cost you less than the numbers on the board to begin solving this problem if you want to act soon. Um, this is a future problem. And I'm telling you that people that get too big an analysis of this kind of stuff, they end up not doing anything, just postponing it. And then we hear from them again when something happens to their health. Because everything you see on this board, you got to qualify for health wise. Every single one of these plans has a health qualification. The ones on the bottom are easier to qualify for than the ones on the top in the middle. Um, just to understand that, that's when we hear back from the shoppers that, oh, so and so just had this, and boy, we really see this. Can we get this? And the answer is maybe. So I just want you, while you're watching this whole video, to be imagining your 80 or your 90-year-old self. And you're just thinking ahead to future problem. And then all of a sudden, your family's in crisis because you've had a health condition or a brain condition that has become a trouble, and it's difficult, and maybe some crisis has happened, like you've fallen, or you've been out driving and you got lost, or just there's all kinds of ways. With my mother, she's on the phone calling my sister and us. She was out driving, and she shouldn't have been driving, and she was lost. She didn't know where she was, and luckily she remembered enough to dial the phone number, and we came and got her. But it's those kind of crises that bring the people in from out of town, and they all of a sudden are sitting down with their parents, figuring out the current situation can't stay. If their parent is alone by then, they're going to need to perhaps go to an assisted living. If they're a couple, or perhaps if it's not a cognitive thing, if it's a physical thing, maybe we can get home health care to come in and take care of them. But if you imagine yourself at 80 or 90, you're not going to be the one driving the bus on this, making the decisions. It's going to be your adult children. And if you're one of these people that can afford to pay for this kind of stuff, but you're saying, I got enough money. If this happens to me, I'll just pay for it. That doesn't look real pretty when your kids are handling it for you when you're 80 or 90 years old and you're in the situation. It's going to be them handling it. And to have a plan in place, to have the funding, because this doesn't make the crisis go away. It just makes you talk about the proper things, is what's going to be best for mom and dad, less than how are we going to pay for this. Because if you don't have insurance, typically that is the topic of discussion. How are we going to pay for this? And that's the crisis. And so what we can do with long-term care insurance is we can have a plan in place, and we just pull it out of the drawer and say, here, this is taken care of. Mom and dad planned for this, and this is how you're going to pay the bill for that, bringing the people in to care for them. Okay, so the benefits you'll notice on these plans, these are 5 different plans, and the benefits are similar. They start at $6,000 a month. They have inflation on them. These top ones, 3% inflation. So money doubles itself every 24 years at 3%. So, that would mean by age 89, you're going to have twice as much insurance as you had at 65. So the 3% inflation is baked in, and it's $6,000 a month. So if we just go to this top one, $6,000 a month, $72,000 a year, $640,000 benefits, that's where you start. If you had a stroke 6 months from now and you immediately needed care, that's the benefit you'd have. But when we get to 80, this thing has grown to $9,000 a month, $108,000 a year of benefits, and $864,000 total. And then at 90, that's $12,000 a month, $144,000 a year, and over $1 million in benefits. Okay, and so that is pretty similar through these top 3. And then the product changes; it becomes an annuity product that has enhanced long-term care benefits. It's just different. but it's still similar around the 6,000 a month to start, more later. And then this bottom product only pays benefits for a year at home, and it pays benefits for a year in a facility. So you could say it's 2-year benefits if you properly timed your care, which would almost be impossible to do, is get the care at home for a year and then switch over to a facility and then stay there for a year. Then you'd be out of benefits. It's much less expensive and much easier to qualify for. So I want to show you, and I've sold this to a lot of very well-to-do people, simply who have just rejected this. They just said, I'm not giving you that much money. I'm not giving you a check for $220,000. Just forget that. Okay. Well, then I tell them the story about the 80-year-old or 90-year-old, that, and the kids taking care of them and all that kind of stuff. And how's these kids going to know what money to pull from and what taxation? And that didn't even work. What I do is this becomes, for a lot of well-to-do people, just a stopgap plan that at least your kids are not going to have to worry about those questions for the first year, or possibly a year and a half, 2 years, is they're going to have something to draw from immediately. And then they can go to your assets after that thing expires. So what we wanted to do today, and I think we've accomplished that, and we're accomplishing that, is the show notes give you all the data that's in a proposal for the couples program, for the single female, the single male, and then the same thing on the IRA policy or the qualified money policy. It gives you all the inner workings of that. On the standard long-term care policy, the traditional, the same thing. On the annuity policy that people with health conditions can possibly qualify for, and the short-term care policy. This is nationwide, this is One America, this is Mutual of Omaha, this is Equitrust, and this is Aetna. Now, what I want you to keep in mind is we have several different companies in each category. So in other words, we don't sell everybody nationwide that wants this particular. So we just put them up as the marquee deal, but there's 2 or 3 other ones that we can go to if there's reason to. Same thing with the IRA money. The difference being this is the only company that lets you use IRA money to purchase a long-term care policy. And many of our clients coming in, this is the only place they have a bulk of money to invest in this kind of thing, is from IRA money. They don't have this much regular money or brokerage account money to make that kind of investment. We don't want to make that for you, but so this is the only company that really works the IRA thing properly. Then with the traditional long-term care, we have a number of different options and a number of different companies that we work with to offer. We just chose Mutual of Omaha as the one we're pricing in here. We don't have a lot of companies to choose from with this particular arrangement of annuity. Equitrust and the Bridge has done a fantastic job of being able to insure people with a number of health conditions. And then the short-term care, we do have 2 or 3 other companies that have a similar product that we can work with in certain situations. We just chose the Aetna product to feature here. Now I want to bring Tom on. I've just kind of given you a summary of what we're going to go over, but I want to bring Tom on for Tom to add some things.
Yeah, I mean, I think one of the things that's important to know about these, I mean, we've given you sort of the examples. You can go look at them. We would always want to build this as part of a larger plan, right? I mean, we don't want to sit here and if you only have $200,000, take it all and put it in a long-term care policy, right? I mean, that wouldn't make a lot of sense. And so this needs to be part of a comprehensive plan looking at all the different pieces together, making sure that it's not money that you might need to live off of. But typically, these type of plans, especially at the top of the board, are people who have the resources. Mentally, they've already set aside this money for the risk of needing long-term care. Mentally, what we're wanting to do is let's just reposition that, get some leverage out of the insurance company, get a little bit more benefits. There's some tax benefits that come along with that, and really get them in a much better position. And so we don't want you to view this as like, hey, everyone needs to do A, B, or C. It needs to be specific to you. It needs to be part of a larger plan. And I think we don't want to go through this board and just go line by line, look at all those numbers, because we're going to essentially all the numbers are pretty identical, right? The top three ones, they're all the same. I mean, we just took a couple on the left side of the board and then a single male and a single female on the right side of the board, just to give you an idea of what that looks like. But I think what might be helpful is if we just go through a little bit and give you some context of why we might recommend the top row, the second row, and those type of things. And so if I'm looking at that top row, like Hans had mentioned, that's the nationwide policy. It's funded with a single premium. You can pay for this over 10 years. And I think Hans actually has those numbers on hand, but we'll get to that in a second. But it doesn't have to be a lump sum. It can be paid over time. But what's nice about that one is those benefits come as an indemnity benefit. You'll notice that on the very left side, we have it written down indemnity or reimbursement. In an indemnity benefit policies, they pay you that benefit. We'll just use a $6,000 a month benefit as cash. You can spend that however you want. You can pay a family member, you can pay a neighbor, you can pay a friend. It doesn't need to be a licensed care provider who you're helping use to cover that risk. And so a lot of people like that flexibility. And it's nice that there's an option that can cover a couple, and there's ones that can do single people. The second row, that's with One America. This is the company that allows you to use IRA money to fund the long-term care. We have other videos where we talk more specifically about how they do that. I don't want to get into that today, but we use this policy a lot of times because that's where most of people's savings are in 401ks, IRAs, and they want to use that to sort of get the leverage of the insurance to cover this biggest risk. And so that second row, a lot of times we're using it because that's where the money is to fund the type of policy. The third row is a traditional long-term care policy. So this is what typically people might think about when they hear the word long-term care. There is no death benefit. The other two have a death benefit component. There is no death benefit. If you need it, it's great there. If you never need care, there's no benefit left. But what's nice about that is you can have a much lower sort of entry into this. It doesn't take a big lump sum up front. You pay for it over time, and you get a lot of, against that leverage for the insurance there. And so some people like that. Some people say, we don't need the death benefit. We'd rather just pay for like homeowners insurance or car insurance. We just have a monthly premium. We pay it, and we know we have the coverage there. That fourth one is with Equitrust is the company. If you want to go look through the show notes and find the illustration, we use this a lot of times when there's health concerns, right? I mean, Hans had mentioned all of these have some level of underwriting to get the policy. And sometimes people come in, they really are interested in this, but we get into it and they just have health conditions that are going to preclude them from those first three. They're just not options. This Equitrust policy is very nice. We're very excited about it to be able to have something to offer people that have some health concerns that prevent them from getting the other one. So we'll use it a lot of times there. It's also an indemnity type policy. Again, they pay the cash. It does need to be funded with a non-qualified money that's not in an IRA or not in a 401k, money you've already paid taxes on. And that last one is a short-term care policy. This one is really nice just to have some coverage there. It's really meaningful coverage. It's not as long of a policy as the ones above. It only pays for a maximum of 2 years, consecutively. Like Hans had mentioned, one at home, one in a facility. Typically, it doesn't line up exactly like that. But it's a way to have a much lower cost option to really get some meaningful coverage to help provide some protection from the sort of largest risk. And so, again, you can look at all the numbers, you can look at the illustrations, but I just wanted to give you a little bit of context of how these different ones fit within sort of a larger plan and why we might pick one over another.
Okay, well, let me focus a little. I'm going to go back to the top and just talk about the money here. So for this standard policy for the couple, both 65, $220,000. So, that's quite a chunk of change to just dump down for long-term care insurance, but you're done paying. And if both of you pass away without ever using it, $216,000 will be paid to your beneficiaries after the second death. So pretty much put the money there. You're not making any interest on it. If you use it to its fullest and you're old, it could be as much as more than $1 million of benefits that you've collected tax-free for your investment. If you use it while you're 80, it's as much as 864,000. This is for the couple. It's covering two people, and they can use the benefits. However, and one could use it for 6 years and the other one 2 years. They could each use it for 4, one for 8 years, the other one for none. But if you use this extensively, there is going to be no death benefit. But if you don't use it at all, there's going to be a pretty substantial. If you just use it a little bit, the little bit of benefits you collected will be deducted from the death benefit. Now, I misspoke when I said there will be no death benefit. There will always be a $21,000 death benefit going to your heirs, which is almost 10% of the money you put into it. If you use up all the death benefit and then the second one of you passes away, there will be a payment of $21,000 to your beneficiaries. Now, over here on the right, this is the same company, not exactly the same policy, but it's bought as an individual. So if you're a single person, or maybe your spouse doesn't want to buy it, or they're uninsurable, if you're married. So on a single female, this is $137,000 single premium. On a single male, $122,000. Now, all these prices are 65 and 65 ages. And if you're younger, it's going to be less. If you're older, it's going to be more. This company doesn't offer this policy beyond age 70. So, you get people in your 70s or in your 80s, we've got to go to a different company and perhaps not have indemnity benefits. But so you're going to be able to take the benefits of this one, and compare it against the others, with the biggest difference being this is an indemnity benefit. So we have a lot of people that buy this plan. They don't buy the inflation. And instead of buying $6,000 a month to start, they buy $10,000 or $12,000 a month now, and then they got 8 years of coverage, and that's going to come to them when they need care without having to send any receipts or bills, use a licensed agency. They're just going to get a check every month, and that check is going to be tax-free. So we're not necessarily going to offer one of these plans. We just made them this standardized benefit so you can compare them and contrast them a bit. Okay? Now, the only difference between this and this is you're now at a reimbursement policy, the One America that we're using IRA money for. So it means you're going to have to use a licensed home health care agency, or you're going to have to go to a licensed assisted living, and you're going to have to show them a receipt or a payment for the amount of the benefit in order to get the benefit. So where I could make this simpler is if you're on this policy and you go in a place and the charge is $5,000 a month and your policy pays $8,000 a month, you're going to get the $8,000 a month, not the $5,000 a month that it actually cost you. With this policy, you go in a place, it's $5,000 a month, and you were there for the first month. Your benefit is $8,000 a month. You're only going to get $5,000. But then that $3,000 that you didn't use stays in your pool, so maybe you could use it longer or something. It's not gone. But that's the difference between indemnity and reimbursement. And this thing for the couple would take $290,000 of IRA money that we would just transfer, and then there wouldn't be a tax event right away. But then over 10 years, don't want to get into a lot of detail, but you're going to be responsible for paying the taxes each year on that transfer, where the IRA will be depleted over 10 years and all the money will be moved over into the long-term care life insurance policy. So another video, another meeting, we'll go over that if that's something that interests you. And for a single female, 165,000 would need to be transferred from the IRA. For a single male, 140,000. Now, it's as Tom said, this third example with Mutual of Omaha, it's a reimbursement policy like the One America. The long-term care benefits are very similar. The difference being that the only way you're going to get anything back out of this policy is to use it for long-term care. And the premium is for life, so it's $12,554 a year for the couple, and you're going to pay that for the rest of your life or the rest of your spouse's life. And it has a waiver of premium on it. When you're actually using it for long-term care, then you're not going to have to pay the premium. And then when you pass away, your spouse is going to continue on with their portion of the premium. But that's a premium for life as opposed to a single payment. And the company could raise the premiums. It's not likely, but it's possible. And with these two, there's no future changes in premiums. Everything's cooked right from the beginning. Then, this fourth area, what this annuity that I wanted to talk about, I just wanted everybody to know these are some examples of who we've been able to get insured on this: rheumatoid arthritis, chronic liver disease, chronic kidney disease, cancer, heart disease, multiple sclerosis, Parkinson's, fibromyalgia, long COVID, type 1 diabetes. I mean, if type 1 diabetes with a lot of units of insulin, all of those conditions I just read, it's going to be very difficult to get one of these three policies covered. And these are all examples of people we've gotten on the highest benefit, which is illustrated here, that have these conditions. I mean, it's amazing to me. These are the numbers with it. And this one, like the others, if you buy this, you put the $115,000 premium in, and you never use it, you pass away, your beneficiary is going to get the amount that the annuity accumulated to, and it'll just be paid to them. It's really amazing. And so again, if you're interested in that, I'm not really trying to explain everything about all of these policies. I'm just trying to tell you the different areas that we could cover you. And then this one, the short-term care, it has a much easier health qualification than these three do. I mean, first of all, there's no cognitive test for this. Not if you have cognitive impairment, you can't buy this because this is a yes/no question application. So you just go through and you put your medications down, and they can check those, and they can pretty much tell what you've got. And it's a pretty liberal application. If what you've got has been pretty well under management for 2 years or 3 years or 1 year, you can, a lot of times we can get you insured on something like this. So it's not really the purpose of this video. Just understand that these two are just as much for people with health conditions as they are premiums. These three are going to have similar underwriting or similar health qualifications, still with probably more room than you think. People come to us with illnesses and they think, oh, I couldn't get this. Well, a lot of times you can. I mean, if what you've got happened a while ago and it's been under good management since then, there's a chance that we can even write to these companies before we send in an application, or we can call them and explain the situation, send them some medical records, and do a look-see to see if there's a chance that they take you. So again, I want to bring Tom back on, and I want to see, I'm going to add some of the state material to each of these, but before I do that, I want Tom to just kind of share what addition added to what I went over.
Yeah, I mean, I think the numbers are there. I don't know that we need to go back over that too much. I do want to bring it back to like, why are we even talking about this, right? I mean, ultimately, the reason you do this planning is because of your family, right? I mean, you want to do this so they're not having to figure out how to pay for this care if this happens, if this crisis event happens. Because all too often we get people coming in. Typically, it's the adult children a parent who's aging, who's needing care, and they're at their wits end. It's like, man, mom and dad, something's happened. We need to put them somewhere. We have no idea what even they have. What money do they have? How do we pay for this? What are the tax implications? I mean, they are just worried about the money piece of it. I mean, yes, they're concerned about their parents, but the money comes like that. That's like gets moved to the top of the line of like how they figure this out. And unfortunately, and they don't necessarily always say this, but you can feel this sometimes. Is they're like, hey, we're spending our inheritance on mom and dad. Now, a lot of kids do that very willingly, but there's some pushback, right? It's like, man, well, maybe we can take care of them for a little while, and not pay this big bill to do this. And ultimately, it's to the detriment of the care for their parents. And so, what you want to have happen if this does occur, if long-term care event happens, you want your kids focused on where is the best place for mom and dad to get cared for. How do we do this in the best way? And the money piece of it is sort of an afterthought because you have the insurance to help cover that cost. And so I just want to put that in context, sort of walk you through if you've never experienced that. That's what that looks like on the back end if there is no plan in place.
Now, a couple added notes by state. I mean, first of all, $220,000 is not the only way to buy this policy. You could spread that premium payment over 10 years, and it's almost $27,000 a year for 10 years. Okay. And so you could just pull that amount out of your IRA and pay the premium over 10 years. You'd have to pull out the amount of the taxes too. So we could set up an insurance product that would pay you for 10 years exactly that amount. So we could, in effect, recreate this product with this product. But I don't want to get too far into the numbers. I'm just showing you that this is just not necessarily what we're going to offer you in your financial plan. This is just a way for you to shop a bit for long-term care and get a sense for how all these things work against each other. The top product with Nationwide, or something similar to it, not the couples version, but the single version, is available in all 50 states in DC. So that's one of the reasons we put it there. This product is available in all 48 states in DC. It's not available in New York or California. And the California has a comparable policy that's available. So we'll comparable but different. This side of the equation is available in all 49 states, but not New York. This product with Mutual of Omaha is available in all 50 states in DC, but it's not exactly this product. It's a little different in a number of states, but for purposes, it's close. So we can offer that to you in all places in the USA. This product is not available in California, Connecticut, Indiana, Maryland, Massachusetts, New York, and Virginia. But Virginia and Maryland and Massachusetts are getting ready to come on. Okay. So if you're watching this a couple months from now, we might be able to offer this to you in those states. And this product is available, I'm just going to tell you, in 37 states. And the ones it's not: California, Connecticut, Florida, Massachusetts, Maine, Minnesota, New Jersey, Vermont, and Washington. You can't buy short-term care insurance. But somewhere we got something for you. Like I said, I know I probably dove deeper into the numbers than we wanted to. You can go into those illustrations, or you can just get in touch with us. And we're more than happy to quote long-term care insurance without doing a whole financial plan for people. But most of the time when we're offering this stuff, it's within the context of a whole financial plan. And within financial planning, we've covered all 7 of the boxes today. I mean, we've touched on them. This is, to me personally, the most important subject that we cover within the context of the 7 worries. So I want to bring Tom back on. I'm Hans Scheil.
And I'm Tom Griffith.
And we thank you very much for listening.
Thank you.